Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates. 10-year note yields still going lower and have made a new low going back. You got to go all the way back to the U.S. elections to get to where 10-year note yields were hovering just above 204 as we speak. And what we've seen here since the market failed to extend the highs back in early August, when recall we were trading at 10-year notes around 240. We've really just plummeted yields. We've seen them come straight down, and the trend has really been strong here. And yeah, there's a lot of uncertainty out there, and there's a lot of economic kind of woes, and we've got we've got the equity market still doing its thing, and ultimately it just seems like now we're starting to look at more geopolitical risks. We've obviously got the hurricane storm risk, the catastrophic risks we'll call them, along with the economic and Federal Reserve uncertainties that have kind of been now front and center. So a lot of reasons why yields are going lower in a flight to quality type of a bid, maybe with a dash of fear in there. As well. And what has it done to volatility? Well, volatility remains subdued. It's not going down, which if you're going back over the last several years, anytime volatility doesn't go down, you kind of raise your eyebrow and say, well, what's going on? Because that's been the way of volatility ever since the Federal Reserve entered the markets back in 2008. But I think ultimately right now, the subdued volatility is more a reflection of the trend. And the trend has been not just going back to August, but if you look at a bigger macro trend, we've seen yields decline pretty much all year with a few hiccups. And I think that right now, that trend is going to continue, and it's on a path to 2%. And once we get to 2%, things could change dramatically. If you see sellers come into the Treasury market, or is it going to be another push through a significant psychological level, a significant level for anyone really trading in the bond business? Because when you get yields at 2% in the 10-year, where else? You got to go somewhere else to get your yield. Like we've been seeing equities rally, we've seen corporate bonds outperform, and that's kind of been why we've seen that. But again, 2% is a target, and if we get there, we could see a bounce. We could see treasuries fade, or we could see them continue. Either way, I think volatility will bid if we get to 2% and then move away from it, whether that means higher or lower. And lastly, I want to talk about the Fed. Obviously, with this ramp up in buying in the Treasury market, there's been a lot of uncertainty. Federal Reserve, right now is kind of a dark cloud. What's going to happen over the next 6 months? We found out this week that Vice Chair Stanley Fischer is going to be taking his leave in mid-October. We've got some other open seats. Lyle Brainerd may be leaving her governorship. So there's a lot of uncertainty around there, and the president's going to have his hands full with appointing replacements for all these. But the key is the Federal Reserve chair, and Yellen's term is up early next year, and there was a favorite running. Gary Cohn was sort of the guy that was going to replace her, and then Yellen's name came back into the hat, and now you got Kevin Warsh in there. You've got a lot of uncertainty as who's going to be running this Fed come next February. And I think that's got the market a little concerned. Likewise, odds of additional rate hikes. We've been talking, they've been declining. They've been between 40 and 50%. And that you can kind of have an argument there for still why they might raise rates or might not. But now we're getting down into the 20% odds. We're really starting to eliminate any chance of the Fed raising rates, which leaves their balance sheet focus. Are they going to address the balance sheet? Are they going to start to maybe taper some of the purchases that they've been making? To me, it seems like with the debt ceiling getting kicked down from October to December, with still tax reform, health care, and a budget all up in the air, I think this may be the market's way of saying we don't think anything's going to happen with the balance sheet come September or December of this year. So this is another reason why I think yields are going down, is that if the Fed's not going to continue to keep rolling the coupons back into their system, then I think that's going to keep yields artificially low, and that's one of the reasons why I think 10-year yields are nearing 2%. So there's a lot up in the air right now, and one thing I haven't even addressed is the potential for what's going to happen after the weekend. We had Harvey come and go, and that left a huge wake of damage, and insurance companies and banks are suffering. And now we've got Irma coming this weekend. It's going to be a lot of the same, could be worse, and so we could see some more flight to quality bids in the Treasury market going forward, at least until we get some clarity of the damage. But along with the Federal Reserve and the geopolitical risks that are on the rise, I think that 10-year notes are probably going to get to 2% and push right through, at least until there's a reason not to. And right now, I don't see that reason, especially if the Fed decides to go full hands off on their balance sheet and on the rates, at least until the end of the year. So right now, it looks like bullish trend will continue, and the fact that volatility hasn't really seen much of an uptick tells me the market believes it as well. This is Todd Colvin coming to you from the floor of the CME Group.